For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Welcome to the show, Johnny Dean, Professor Rick Plum, whistling along to our theme music. Is that what you're doing, Professor Plum? I was trying to figure out. I don't think I turned your mic on yet, but you're whistling along to our theme music here. I appreciate you folks being here. Of course, it is Managing Your Financial Future. Johnny Dean, your podcast host, introducing myself and introducing Professor Rick Plum. I know I say we talk to different Lucia Capital Group advisors as guests, but you're the easiest one to get a hold of, Professor. So 95% of the time it's you. Don't you feel honored?
Yeah, either that or I feel like I'm not doing enough work in the other side of the world because they're all busy and I have time to do this.
Well, that's true. Now, I've only got you for like a half hour, I think. So we're going to have to keep this thing. We're going to have to keep this thing moving because you actually are kind of a busy guy. Appreciate you being here as we close in. Here I go again, closing in on episode 200. This is like 197.
You've been talking about this for 6 months.
It's ridiculous. And again, as I said last week, nothing is going to happen until it's not going to matter. I don't know why, but I have it sitting right here in front of me, episode 197. Okay, well, I just feel kind of important in that regard. Speaking of important, we got some important topics to talk about. Important, really, and you may not think it's as important as it actually is. Most of the stuff that we talk about on this show, in fact, I would say 97% of it, let's say, is extremely important stuff that you need to know. The other 3% is Professor Plum and me just doing movie lines and things like that.
Having fun.
Which is really the fun part of the show, and we're going to have to do that at some point. But the important things that we cover are things that I think a lot of people don't even recognize their actual importance. And this topic today, which has to do with asset allocation and asset location. Now, Professor, this sounds really scholarly. Does it not? Does it sound textbook type to you?
Well, it's just a couple of letters different. Allocation versus location. I mean, well, it can't be that big of a deal, right?
It looks like one of those things that you would find in a textbook when you get to Unit 4 of your economics, your personal finance textbook. Now, when you were in college, your major was it personal finance? It was something like that.
It was finance with a financial planning emphasis.
That's what it was. And so you did study this stuff. And
I did, but I didn't study asset location as part of the curriculum.
Right. And so this is why we're bringing this up. And this is why I said it's an important topic, because only half of the story is generally told, not just to clients and people who are putting their money with a financial advisor, but to people who are learning about this. The advisors themselves oftentimes are not taught about the importance of it. I'm not saying that they're all like that, but certainly a good portion, Professor Plum, don't either understand that asset location exists, or if they do, they don't really understand the difference.
Well, and there is a difference. And I don't know what's being taught in today's curriculum as far as the degrees and things of that nature, because when I was learning the different planning topics and things of that nature, the tax code was very different. And so the location didn't have quite the same issue, although it had some of an issue. It didn't have quite the same issue as it has today. We didn't have the preferential capital gains tax treatment.
Right.
We didn't have anywhere near as much IRA or 401k money back then either, because those were actually fairly new when I was studying, in the dark ages of financial planning.
That's old.
Long time ago.
Whoa.
But as the world has progressed and as our savings and investing, preferences and availability or options have progressed, things have come about that asset location has taken on a much more important role, but it is still it's not the first thing you do. Your first thing you do is find out your asset allocation so that you can identify the appropriate investments overall to be in. And then what location has to do with is, okay, now I know that I need X amount of dollars of my portfolio in growth, in safety, in a certain type of investment, multiple different types of investments. Which accounts that I may have, tax-deferred accounts, tax-free Roth accounts, personal accounts, or even non-qualified annuities that some people may have. Which accounts do I put, which investments do I use in which accounts?
Yes.
Do I put my growth investments in my IRA or my personal name or in my Roth name? Do I put my income assets in XYZ? Where do I do? And what does it matter?
Yeah.
Why should I even care?
Well, we're going to talk about this, and we're going to break that down because the fact that the two are inextricably linked tells me, to go back to the importance of it, tells me that there is knowledge that needs to be had in this particular arena. So let's talk about this. Many people, if not most, if they've paid attention at all to finance or investing, have at least heard of something called asset allocation. Even if they don't necessarily know what it is, let's start with that, Professor Plum, and dissect that for just a moment and go over what we need to know about asset allocation and why we need to know what that is first.
Well, it's been beat into our heads since the 50s. Modern portfolio theory, asset allocation determines 92% of your overall long-term rate of return. Having the appropriate allocation to try to reduce risk and volatility is a driving force on all this, what we're trying to be doing. Now, I don't necessarily agree with all that as life has changed and processes and strategies have evolved. But asset allocation is something that's been diversification has been beat into our heads for 70 plus years now. And so it's just one of those things that, yes, asset allocation, and on the grand scale of things, asset allocation matters tremendously. How much money I have in stocks versus how much money I have in safety and or fixed income or alternatives or the other types of investments that might be out there is a very important issue. And it's based on your time horizon, your cash flow needs, your goals, your age, and things of that nature. All of these play a part in creating your asset allocation. Bottom line is, how much money can I afford to have in stocks? How much money should I, from a risk management standpoint, have in safer, less volatile or non-volatile assets? How much money should I have in bonds, if any, or things of that nature? So it's telling me what types of investments, not necessarily which specific stock to have, but it's telling me whether I can afford to have stocks with that money or not. And so it's telling me what types of investments I should be looking for overall.
Okay.
So I should have, even the basic incorrect strategies of the balanced 60-40 mix at age 65. It's saying, okay, you should have 60% stocks and 40% bonds. Now you're going to go look at now you've got a big question of, okay, I've got to have 40% in bonds if I agree with that. I don't. I'm just bringing it up for example. Do I want short-term bonds, mid-term bonds? Do I do a strategic portfolio of all the types of bonds? Do I do treasuries? Do I do corporate? Do I do municipals? What kind of bonds do I have? So it's really an overall high-level type of how much you should have here and there.
So sticking on the allocation portion just right now for the moment, how do you determine what somebody's asset allocation should be? I mean,
it's easy. You start with 100, you subtract your age, and that tells you how much in stocks you should have.
Okay, yes.
I am being facetious.
Joking.
That is not the right way to do it. Unfortunately, that is what people write about and we hear about on the journalist side of things. The appropriate way to determine what your asset allocation is or should be is based on your needs. And it's based on your emotional risk temperament. So the first thing is, what do you need from this money? You've got X amount of dollars. What are you trying to accomplish with this money? And so you're 35 years old. It's in your 401k or your IRA. You're not supposed to touch it for 25 years at minimum without a penalty. By definition, that's long term. That means you should be investing it for long term in long term investments. unless you can't emotionally handle the volatility that comes along with that type of investing. But the reality is 35-year-old 401k IRA should be in growth. That's pure and simple. Now, when you get closer to the idea that, well, I need to start spending some of the money that is in my account, my investment portfolio, now it's a matter of, well, when might you need to spend it and how much? I'm 61 and I'm going to retire in 4 years and I need $50,000 a year. Well, you want to make sure that that money, especially for the early part of your spending needs, 5 years, 4, 6 years, 7 years from now, the market could go down between now and then. I don't know what it's going to do over the next 3-4 years. And you want to be able to still retire and start taking that $50,000 out when you want to retire. So you need to be, you cannot afford, in my opinion, you cannot afford the volatility of the market with that shorter term side of the money. But just because you're 61 and you want to retire in 4 years doesn't mean you're going to spend all of the money in 4 years.
Right.
So you don't want to put all of the money in 4-year time horizon. You put enough money in 4, 5, 6-year time horizon to satisfy your needs for that period of time. And then you've got, you're 61. You could very easily live to 85, 90. Some of the money, you still got a 15-year time horizon. You should be investing some of the money for growth. How do you find out how much? Let's do some math. Oh my gosh, a 4-letter word. I brought it up. And find out how much money we should have and discuss what volatility you're willing to accept. We can look at rolling, 10-year periods of time. We can look at what is the likelihood that your growth investments will achieve a positive result over this period of time that you're setting aside. Over a 4-year period of time, you've got a decent chance of losing money over that 4-year period of time. Over a 15-year period of time, if we look at 15-year rolling periods after the 1929 crash, you've got a very good chance of having a positive outcome.
Historically speaking, statistically speaking only, no guarantee that going forward that's going to do that, but that's the best you can do.
But even including, if we looked over the last 150 plus years, the worst 15-year rolling period of time was like a minus 0.3%. And that happened in the late 1800s, early 1900s.
Yeah.
And the rules have changed since then. So, the longer the time horizon we have, the more likely the outcome for a stock portfolio in a positive manner. So the more emphasis we can put on the stocks.
Yeah.
The shorter the time horizon, the bigger the likelihood, the larger the likelihood that you could experience a negative and sometimes a fairly sizable negative return over a 1 or 2 year period of time. And because I don't know, you don't know, nobody knows what's going to happen over the next 1, 2 years, 3 years. You can't really take that kind of volatility. Now, this is where I'm using a term that people say, well, you're talking about risk, Rick. No, I'm talking about volatility. Volatility and risk are not the same thing. Volatility with the stock market is the temporary reduction in value, but you're still invested, and so the longer the time horizon, the more likely you can recover from that temporary reduction in value. Risk is the permanent reduction in value because I had to sell it to create the cash because I needed the cash to spend, or I just couldn't afford emotionally to handle the downtime.
Yeah, we've talked about in episodes prior about the fact that risk is not volatility, volatility is not risk, and that's another important thing that nobody seems to bring up. So now you've determined, Professor Plum, for somebody based on the criteria that you just sort of went through for the last couple of minutes.
Well, you do a buckets plan is what you do. You do your bucket strategy, and that will tell you how much money you should have in bucket number 1, and we know what kind of investments go in bucket number 1. We go safe, low volatility or no volatility. We're stressing principal protection or value of principal rather than return. And then we know how much money we need in a midterm account. We know how much money we need in a long-term account. Yeah. Long-term accounts, we value return over. We don't need liquidity because we've got 15 years or so. We don't need total principal protection because we've got time for it to recover. So the bucket strategy helps us determine what the overall allocation
Yes.
should be of your investment portfolio.
That's the basic tenet of the bucket strategy, and that's what it helps you determine. But that's only half the story. And I want to cover here for a few minutes the equally important, if in not some cases more important aspect of this, which is the location of your assets. And the thing, as I said earlier, that many I hesitate to say many, but I'm going to. Many advisors tend to overlook either the process of asset location or the importance of it. Professor Plum, talk about what location is.
Well, location has to do with which accounts, Roth, traditional, for tax-deferred 401k, IRA, or personal, which accounts hold which assets. We know we're going to have some fixed income assets, some CDs and things of that nature. We know we're going to have some stocks, some growth investments, ETFs, growth ETFs. Should they be in my personal account? Should they be in my Roth account? Should they be in my IRA account? Obviously, presuming you have all three. Okay. Now, a lot of people retire, and the only thing they have are their 401ks or tax-deferred accounts. Well, asset location is pretty simple in that respect. It's all in the IRA because that's the only thing you've got. But you also then, for a lot of people, we have personal money, either because we saved it or some people inherited it, and now they've got personal money. They've built up their Roth. They've listened to us on the super mega funded Roth option that they have with their 401k. So they built up sizable Roth accounts before they retired, or they did conversions and built up sizable Roth accounts either before they retired or while they retired.
Right.
And so it's just a matter of, where is the money and how should we look at it? We have to look at the underlying taxation. We have to look at what other income they already have. Do they have pensions? Do they only have Social Security? Do they even have Social Security yet? Have they started it? So we will look at the other incomes and we determine where they are on the tax bracket to see how much more income we can take without adversely affecting their tax bracket, their marginal bracket, or potentially even affecting their Social Security. And we look to start taking money out of the accounts in a tax-managed, efficient way.
Yeah, so the idea...
Also taking into consideration that by the time you're 73 or a little bit later on 75, we're going to have to take money out of our IRAs or 401ks because of required minimum distributions.
So the whole idea of location is really a tax play when it comes right down to it.
Very much so.
It is, and the reason I think that many people don't think about this whole idea is because taxes are kind of a thing that a lot of folks just either don't understand or don't want to understand, or they'll worry about it later, or their mentality might be, let's just pay as little as we can right now and save the rest for somewhere down the road. And that's where people can get in trouble.
Or they just don't think you can do anything about it, and it's just inevitable. Yeah. We'll just accept it as it goes. There's nothing I can do about it. And that may be true for some people, but it's not true for a lot of people. And you do potentially have the ability to affect the amount of taxes you pay. And taxes, for the way I look at taxes, especially for a retiree, it's an expense. That is part of your expense. And so is it an expense that we want to have? Or is it an expense that we have to have? But either way, we have to find a way to make it work for you as efficiently as possible.
So on the location side, you mentioned the three, really. You've got the Roth side, you've got the personal type of accounts, and then you have, we'll say, IRA, pre-tax, whatever you want to call them. Sometimes
tax-deferred.
We'll call it tax deferred. That's true. Although Roth could technically be called tax deferred until you follow the rules. But if you want to get down to it, we'll call that tax deferred money. So this being a tax play, I mean, if you're looking at it strictly from a tax standpoint, would you agree that perhaps the more you have in a Roth type account, generally the better off you are? Or is this just too generic a statement?
Well, if I could wave a magic wand, and without any cost to me, turn everything I have into Roth IRA, oh heavens, yes, I would like to have it all be Roth IRA. Right. But to have a Roth IRA, there was a cost to do that.
The cost
was, the price of admission was I did not get to save any taxes when I put the money in, versus saving the taxes when I get to take it out. And so what was my cost? And so a lot of people don't have that large Roth IRA when they get to retirement. Some people have done a very good job with it, and for whatever reason, they have decent sized Roths. But it's the wild card, because we'll see how big it is compared to the overall portfolio and see how it plays into the game. Like I said before, a lot of retirees have one type of account, tax deferred. Everything was 401k, IRA, tax deferred money, and so their allocation location is very simple. But what if you have the ability to have personal money? Now, personal money has the difference with a traditional IRA and a Roth IRA. Either one, they're both, as you mentioned, they're both tax deferred. So whatever happens in them while it's happening does not affect our tax bracket right now. It's only when we start taking distributions. On the other side, personal money, whether it's a living trust or my personal joint name, my individual name, whatever happens at that investment level could have an immediate impact on my tax bill right now. Because even if I don't spend, if I have $100,000 in a CD earning 5%, if I can find those nowadays, it's going to earn $5,000. That $5,000 is taxable whether I spend it or don't spend it. If I just re-up the CD and redo it and just keep rolling it, I still pay taxes on that interest that I earn every year. Now, that is hard for me to pay taxes today, but it helps me in the future, because if I have 100 today and it grows by 5 and I pay taxes on 5, and it grows by another 5 and I pay taxes on that 5, 2 years from now it's worth 110. I've already paid the taxes on the 5,000 of growth. I can take that full 110 and do whatever I want with it and not have to pay any taxes on it, because I've already paid the taxes on it. Versus in an IRA, I don't have to pay any taxes right now, don't have to pay any taxes next year. But when I start taking the money out, I got to pay taxes on not only the 100 that I had in there to begin with, but the 5 that I also earned while I was deferring it. So we have to look at what the tax treatment is, either when we make the distribution or right now while we're not making the distribution. And so how does it work? How do we make it fit into your situation? Because we can manipulate our cash flow. I could take, if I put $250,000 in CDs, I may be earning, what is that, $12,500 if I do my math right in interest, but I'm taking $50,000 a year out of that account in cash flow that I can spend, but I only had to pay tax on $12,500 the first year, $10,500 the next year, and down the line, because I'm earning less money. No, it's $25,000. Yeah, $25,000 in interest. So it's just a matter of 250. That's 10%.
No, it's 5. It's 5%. I was right. You're right. 12.5.
I was right. Start second guessing myself.
Don't do that. You're the professor.
So I could, I could get $50,000 of cash flow for the next 5 years out of that $250,000 and pay very little in taxes. Versus if I put $250,000 in my IRA and took $50,000 out of my IRA, I'm paying taxes on the full $50,000. So if I had, if I wanted $100,000, but I didn't want to show $100,000 of taxation, maybe I split it 50-50 and I show 62.5 of taxation, which may keep me under the next tax bracket, which may keep me under the IRMA limit, which may keep me under the net investment income tax limit, which may keep me under a lot of bad things that happen on the tax code as you go higher on the income.
Well, so what you're doing here to sum this up, just so we don't get too complicated, and I know we're throwing a lot of numbers out here, and I don't want it to get too complicated for people to understand. What you're demonstrating is when you have these different accounts, these different locations of your assets, you have certain options that you may not otherwise have to try to manipulate it. Now, you mentioned, Professor, that many people, because they just save mostly in their 401ks, right, or the IRAs.
If it came in the paycheck, it went into the checking account, especially when you had the kids, it got spent.
Yeah.
The only way to save anything was to make sure there was a wall between you and it, a tax and penalty wall, which the 401k and the IRA provided.
So if asset location is this important, though, Professor Plum, and many people, just because this is the nature of the game, have money strictly, almost all of it in tax deferred, meaning their 401k or IRA, does this mean that they don't have a lot of options for themselves? Or
no, they have different options.
Okay, so what do you do?
So we look at, okay, what are we spending? How much do we need to live? We need X amount of dollars. Maybe we need $50,000 to live. And doing that, and with the Social Security that we have, that we're already maxed out. They only have the IRA, so we're going to take it out of the IRA. That's maxed out the taxability of my Social Security, but it hasn't maxed out my tax bracket. I may have $20,000 or $30,000 worth of room still in the current 12% income tax bracket, or whatever the bracket might be that you're in. That may mean, you know what? I want to take more money out of my IRA because I'm never going to be in a lower bracket. My surviving spouse will never be in a lower bracket. My kids are not going to be in a lower bracket. So let me take out an extra $20,000 or $30,000 from my IRA and convert it to Roth in the current tax bracket without affecting other things. I'm going to pay it anyway. Let me get it to Roth so that when if I live long enough, 20, 30 years, whatever the case, I'll have a lot of extra money tax-free. If I don't live that long, but my spouse does, they have a much better tax situation because they're going to inherit the Roth and what's left of the traditional IRA. But now they have two types, a tax-free account and the taxable account. And from an inheritance, you talked about what would you rather have on your own. I'll change that to what would you rather inherit, a traditional IRA or a Roth IRA? If I'm getting the same dollar amount, I want the Roth IRA because it'll be tax-free to me.
And no
required
R&D.
minimum distributions are going to be the same. But if somebody's going to leave me $100,000, only, gosh, if that were only the case. And I had the choice of choosing, I can either inherit the traditional IRA or I can inherit the Roth IRA. I want the Roth IRA. Come on, let's be realistic, because it's not costing me anything to do anything here. But but it does help. So this is where sometimes actually paying a little more in taxes today will help me in the future. And let's say I'm taking that X amount of dollars out of my IRA, but it's not enough and the IRA is growing, so my required minimum distribution is going to be larger in the future, which is going to screw up my tax bracket in the future. Maybe screw up my IRMA, my required minimum, not my required, my Medicare payments and all that. So using the bracket now will help me even in my own life because it will reduce, obviously, if I'm taking money out of my IRA today and converting it to Roth, that's less money in the IRA. The less money in the IRA in the future, the less the RMD, the better the tax treatment I'm going to get going forward.
Oh, people's heads are just swimming here. But this is the professor, you see, and this is the kind of stuff that you look at. These are logical things that are spinning in your head, Professor Plum, and spewing these ideas that you have as you're taking a look at somebody's asset location. It's always good to have options, I think you would agree. But even if you don't have a lot of options, in other words, you got most of your money in that tax deferred, there are still things that you could do, as you just pointed out.
Right, there are still potentially options. And having some Roth money, and it may be that, okay, it's only $10,000 extra a year. So you do that for 5, 6, 8 years, whatever. And then all of a sudden you decide, I need a new car. And the loan rates for whatever are not good, and you don't want to you want to pay cash, but you don't want to take a 30, 40, 50, that you can't even buy a car for 30, 40, 50, $60,000, $70,000 lump sum from your IRA, but you've over the years built up a Roth. You can always use the Roth for that, or a little of both. Maybe you're willing to take 20 out of the IRA and take the rest out of the Roth, tax free. You're prepaying that tax bill that you're going to use. I like it.
I like it too, and for people who are saying this seems like awfully complicated stuff, what would you say? What do people need to understand the most about asset allocation versus asset location, and why would you tell them, if you had to sum this up for somebody, why would you tell them that asset location is equally important, if not more so, than their allocation?
Well, asset allocation is the driving force of your investment philosophy. Asset location can help dictate the driving force of your tax situation.
Yes.
So taxes are not fun. Now, I was teaching a class this morning for some younger advisors, and we were going through a tax return. We were going through line by line. Where does that number come from, and why does it matter? Why should we even care? And it came down to one of the things that, as an advisor, I can't guarantee you that the portfolio that I'm using will outperform everything else in the world, and be the greatest performance. I may not pick the best stock over the next 12 months. Hardly anybody can. But if I can save you some amount of money, small or large, in taxes, or manage your taxes, that's money that you've earned right now, today, and people love that. And I love that. When I can save taxes on my tax return, I love it.
Well,
And it doesn't even have to be a big amount. It's just the fact that I'm I'm beating the man on this one.
Well, so that's true. So even if you were middle of the road, maybe in performance for whatever reason, and there's nothing wrong with that.
I'm not talking about the fact that this is immediate.
Yes.
This is identifiable, and it's taxes that we're saving.
It's like sticking it to the man is what you're doing.
Going down and finding something on sale and saving money on an item you want to buy is fun.
Isn't it great? I mean,
but saving money on taxes feels even better.
Listen to the forceful way you say that.
It's just knowing that you can save. If you can save money on taxes, it's like such a gratifying, wonderful feeling.
Yeah, it's a bargain. I got to tell you, I've spent some time in consignment shops. Have you ever been to these? Where people sell them, they don't want it anymore, so they send it to a consignment shop, and generally you can get it cheaper. But I tell you what, sometimes you can find just an incredible bargain on wall hangings where the frame is worth twice as much as what you're paying for this thing, and it feels so good. And so I can identify with that. It's like when you save money on taxes, Professor.
But saving money on taxes is even more gratifying than saving money on that painting you were just talking about.
It really is, because it just of the whole nature of it. But you would say, well, if I can save a good amount of money in taxes, that's almost like getting a higher rate of return in a reverse kind of way. Is that?
Well, it is. I mean, especially for somebody who's retired and basically living on a fixed income.
Yes.
If you want to look at it that way. If I can reduce the overall expense or manage a portion of my expenses to my favor, that means that I have more money out of my fixed income to spend on things that I really do want to spend it on.
Yes.
Nobody wants to spend it on taxes. I have not met them. I guess I shouldn't say nobody. There may be somebody out there that does. I haven't met them. But most people do not want to spend money on taxes, but it is part of their budget.
Yeah.
It's part of their expenses. Whether it comes out of their IRA through withholding, whether they're withholding it on your Social Security, yes, you can withhold taxes on Social Security, or however you're paying the taxes you owe. If you can reduce that, you have more money, which means you either can spend more money or you can take less money out of your portfolio, allowing your portfolio to grow more.
It's been said that taxes are the biggest drag on people's performance, maybe outside of investor behavior, which may be bigger than that. But taxes are one of the biggest drags on the rate of return of your portfolio. So if you can save that, you can actually improve the performance, and you have that under your control. Professor Plum, just very quickly, I'm sure you've seen this. People tend to not pay as close attention to taxes. You've seen it over and over, I'm sure, where their portfolio is completely tax inefficient or very close to completely tax inefficient, and there are ways to correct
backwards.
this. Yeah, absolutely. You'd really be surprised at how many people are leaving money on the table that they don't have to.
This isn't the same thing, but it comes down to what people believe is better for them. I was talking to some people yesterday actually, about debt, trying to get out of debt and things, and I've seen people paying an extra $100 on their mortgage that's at 4%, and they've got 28 years left on it, instead of paying that extra $100 on their $10,000 worth of credit card debt at 29%.
Yeah. And
they're saying, well, I want to pay off my mortgage. I want to be debt-free, my mortgage debt-free sooner than, so I want to pay it off a little bit sooner than I don't want to have another 28 years to pay. Paying an extra $100 on that mortgage is going to shorten it from 28 years to 27 years. But if you instead put it against that 29% credit card debt, you'll get rid of the credit card debt, and then you can take the payment that you were making towards the credit card and the $100 and put it towards the mortgage and be paid off even sooner. But they don't look at the big picture. They don't look at the whole side of everything, and so they tend to focus on one thing and one thing only, like, I got to reduce my taxes to nothing this year, or I got to defer as much as possible. Sometimes it doesn't make sense to defer. Sometimes it's better to pay a little tax today instead of a lot later on. It's better to look at the big picture and understand the implications of everything, including the ultimate RMD, required minimum distribution, that you're going to be faced with. How does that fit into the game?
Yeah.
Put the puzzle together on the big picture side.
You don't have to enjoy it. Just allow Professor Plum to do his work, because he really enjoys this. I love seeing how animated and excited you get as these things just come to your mind. We could do this, and that could lead to that, and then this could do this, and then really, it's something to see, and I like that. You want to learn more about this? You want Professor Plum to take a look at your portfolio? If that hasn't happened yet, many of you have done so, but if you'd like to have him look at it, or any of the Lucia Capital Group advisors, give them a call, 800-644-1150, 800-644-1150, or go to luciacap.com, luciacap.com. That's the website. Get in touch with them. Talk to them. They'll take a look at your portfolio. You can say, look, I don't know if I'm tax efficient or not. Maybe I am. Here's how you can help me the most, or whatever your situation may be. This is one place where I believe they really do excel among many. Folks
now,
at Lucia
I will
Capital.
caution it.
Yes?
We can't work miracles on everybody. Some people are. There's just nothing you can do. You're there.
Well, no.
But most people we can help a little bit here or there.
Yeah, there's usually something, and in some cases there's a lot you can do. 800-644-1150, or as I said, luciacap.com. Listen to this podcast every single week. Download it to your device, and don't miss a single episode. You go to Spotify, you can go to Apple Podcasts, subscribe, and listen, as I said, every single week. Do not miss something, because if you miss something, you're going to miss a lot. And we don't like that when people do that. That's it for us. Hey, Professor, thanks so much. I know you got to get back to work. You actually do have to get back to work, and I've held you a little bit overtime here. But you know what? Hey, you're a media star, right?
I get overtime.
Okay, well, even better, right?
Right.
Kind of like your old grocery store union days. Remember those?
I do.
Yes, volunteering to work on holidays. Wow.
Yeah, that was big time money.
Unfortunately, no overtime here, but we're going to let you get back to work. That's it for us. For Professor Rick Plum, certified financial planner professional, and
accredited wealth management advisor.
That's it. I'm your podcast host, Johnny Dean. Thanks so much for listening. Talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. An asset allocation strategy does not ensure a profit or protect against loss. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties. Annuities are not FDIC insured. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. The strategies employed in the management of alternative investments may accelerate the velocity of potential losses. CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. Before investing, carefully consider an exchange-traded fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. LPL Financial, California Insurance License Number 0518721. LPLIA, California Insurance License Number 0B91442.